Hello, everybody. This is Alan Ellman, the Blue Collar Investor, and welcome to this detailed video presentation of the BCI Trade Management Calculator. Over the years, members of the BCI community have asked us if we can provide them with a trading log where trades can be entered, get initial calculations, then the trades can be adjusted through exit strategies, and then post-adjustment calculations made for each individual trade and for the total portfolios. Now, I think most of our members were thinking in terms of a manual trading log where they can actually write in and then self-calculate. But we decided to attempt a project to create an automated spreadsheet that will do this for us, allow us to enter, manage, adjust our trades, get initial post-adjustment calculations for each individual trade as well as for the total portfolio. Well, this project took us over a year and a half, and today you will be seeing a video presentation of the results of all that work. Now, since the spreadsheet is much too large to show you on one screenshot, the best way to do this is to show you, get a perspective top to bottom, and then we'll go left to right. And then you'll actually see me entering trades both in the covered call writing section, the top, and the selling cash secured put section, the bottom. So we're going to start top to bottom. Now you could see at the very top of this screenshot that we enter the option month and year for the particular cycle we're dealing with, and then the expiration date for that particular contract, and the spreadsheet will calculate the number of days to expiration. So tomorrow it'll be 11. So that information will be both on the left and the right sides of the spreadsheet and top to bottom. Now, the top section, as I said, is covered call writing, and we'll go left to right after we go top to bottom, and you'll see the sections for both covered call writing and selling cash secured puts. Now, folks, you'll notice at the bottom, we have 4 tabs. The first tab is what you're looking at now, the Trade Management Calculator, which is the meat and potatoes of the overall title of the trade management system. But we have 3 other tabs, so let me show you those. We have the user guide, and it's quite extensive. The user guide will show you each cell, what they represent, how to make your entries, why to make your entries. And that information is inherent in the spreadsheet itself on tab number 2. Now, those of you who get the calculator and make the purchase, you'll also be receiving a PDF file of the user guide in addition to the one inherent in the spreadsheet, and that will be about 25 pages. So you'll have a reference guide until you get familiar with everything, all the tools inherent in this one particular calculator. The last 2 tabs are worksheets for covered call writing. We have the What Now tab, which many of you are probably familiar with from our other BCI spreadsheets relating to rolling an option, covered call option, and Unwinding Now, which is closing a covered call position mid-contract, actually closing both legs, the stock and the option legs of a contract. So those are worksheets which you could use before entering it into the main tool, which is our trade management calculator. We're back to that now. So once again, we're going top to bottom, and you see the top section is dedicated to covered call writing. Now we're going to scroll down a little bit more, and you'll see that we have something called the capital adjustment entry section. And I'm going to actually get into details on that towards the end of this video presentation, but that's going to be used when we use multiple exit strategies in the same contract month. I'll show you how to use it, why to use it, when to use it, and I think you'll understand why this is such a valuable part of the spreadsheet. Now, on the bottom right here, you can see a little bit of, in these green and yellow cells here, in section 2, which I'll show you when we go left to right, you'll also get calculations for the total portfolio. So that's coming up shortly. Now we continue to go down, and lo and behold, we have our cash secured put section. So the top half of this tool is dedicated to covered call writing, the lower half to selling cash secured puts. You'll see the 4 tabs at the bottom are with us all the time. And then if we scroll down, you also will have that capital adjustment entry section for selling puts, as well as you can see a little piece of the total portfolio initial calculation results. We'll show you that in more detail when we go top to bottom and left to right. Okay, so now we're back at the top. And once again, you'll recall that the top portion of the spreadsheet is dedicated to covered call writing. So each section, covered call writing and selling cash secured puts, has 4 sections to it. So let's get started now with the section all the way to the left, and that's our trade entries. And for our trade entries, we put in the stock symbol. You can also put in things like the industry, the earnings report date, and the ex-dividend date, as well as the expiration date. Now, inherent in this spreadsheet are definitions and information on the titles. So all you do is put your cursor over the title of each column, and it will give you what that particular title represents. It will give you other information like ex-dividend dates are the most common reason for early exercise. So that information on the title of each of these columns is inherent in the spreadsheet. You don't have to go to the user guide to get an overview idea of what each column represents. So section 1, that information is gleaned from an option chain, and you enter the information on the premium that you received, the number of shares that you purchased, that you're writing these options on, and that information is in the blue cell. So that's section 1. Now we're going to move over, kind of scroll to the left a little bit, and we're going to move over to section 2, which are the white cells you're seeing now, and actually the white and the yellow cells. So let's go through that. The spreadsheet will tell us the number of days in the trade from when the initial trade entry was made until contract expiration. So if we stay in that particular trade through expiration, that will give us the number of days in that particular trade. It will give us a dollar per share time value profit, and if it's an in-the-money strike, the intrinsic value, and if it's an out-of-the-money strike, the upside potential, the amount that we can generate if the price moves up to the out-of-the-money strike. We get our break-even price point, as well as the percent return on our option based on the amount of cash invested. And based on the number of days in the trade, it will also annualize that. So you have a perspective of the annualized return, so you're comparing apples to apples with other trades. Now, we'll also give you a percent of upside potential if we use an out-of-the-money strike, and the percent of downside protection of the time value profit if we use an in-the-money strike. Once again, you could kind of put your cursor over what the title is. It'll give you a brief description. And of course, a detailed explanation of all this is in our books and online video courses. It will give us the time value premium based on the number of contracts sold or the number of underlying shares. It will give us the upside premium potential if we use that of the money strikes, and the capital invested. Now, in addition to that, you will have your exit guideline price points. For covered call writing, it's 20% guideline. You have an explanation here, 10% guideline, and 7% stock exit guideline. So all that information is in section 2 and is the result of our entries into section 1, which was the initial structuring of the trade. Okay, there's 4 sections left to right. That was section 2. So let's move over now to section 3. Okay, the blue cell, section 3. Now, the ticker symbol of the stock or ETF will automatically move over from section 1, so you don't have to put that in again. Now, there are over 20 exit strategies between covered call writing and selling cash secured puts that we can choose from. And the way we do that is just to highlight a particular cell where we want to enter the exit strategy we're considering, and then go to this drop-down arrow and click on whichever exit strategy we want to select. And that will then appear in the exit strategy selected column. Now, you put down the date that you're making this adjustment. And if there is a new expiration date, you enter that. Buy to close, sell to open premiums, depending on the strategy you're using. You don't have to fill in all the columns depending on the strategy. And if you're not sure, that information is detailed in the user guide. So you can't make any mistakes as long as you reference the user guide. And then once you get familiar with it, you won't need the user guide anymore. So if you're changing the strike price, you enter that. If you're selling the stock, the final sale price. If you're going to retain the stock, the price at expiration. And that information is all put into the blue cells or section 3 of the covered call writing aspect of the spreadsheet. And then section 4, all the way to the right, gives you your calculated final post-adjustment results. So what's the net option profit or loss? And what's the net option profit or loss for all the shares? You get per share and you get for the total number of shares. What is the percent return based on our investment? And then it will get to the stock section. Our profit and loss realized, our profit and loss unrealized. And then the last two columns to the right will combine the stock and the option portion of our trades in terms of total dollars and in terms of percentile based on our investment or our cost basis. Now, if we scroll down, you will see that we have our final number of contracts post-adjustment. In this particular case, we took in 2756. We had 2415 in option premium, and we actually had 800 in realized stock profit, a loss of 459 in unrealized stock loss. All that information is in the total portfolio returns, and we had actually a net cash return of 2756. Now you could, after you enter section 2, it will give you your initial number of contracts, initial returns, and then after the post-adjustment, you will get your final return. So you can see you started out at 5.08%, and then after adjustment, 6.17%. So we got more than 1% more post-adjustment. So let's go back now to the top, and let's actually do a covered call trade. So we're back to section 1. You could see here that I left the top row open so you can actually watch me enter a trade. Now, I'm going to use T-Mobile US. You see it's a trade that I have on line 9 over here. Actually took this from an article I wrote on the blog. And so we're going to use, you see here, the price of T-Mobile was $79.59, and I'm showing the $77.50 in the money strike. Let's do T-Mobile and use an $82.50 strike, everything else the same, okay? So here we go. TMUS over here. You can put in the industry. The trade date was 5/18, that stays the same. 2020. Earnings report date 6/20. Ex-dividend date 6/26. Okay, the expiration date was 6/19. And the price 79.59. This is as fast as I type, folks. And the strike price, we're going to go out of the money. And that generated $2.30. That was from the option chain when I did this article. 100 shares. Okay. So that's the entry now. So that's section 1. And I'm going to slide over now to section 2. And it tells us that there's 33, would be the same, 33 days in the trade if we take it to expiration. Here's our time value premium per share, $2.30, with an upside potential of 2.91%. Our break-even price point, 77.29. Now our time value initial profit is 2.89%, which based on a 33-day trade annualizes out to 31.96%. In addition to that, since we used an out-of-the-money strike, we have an opportunity for an additional 3.66% if T-Mobile moves up to that 82.50 strike. Since we're using an out-of-the-money strike, there's no downside protection of that time value profit, but we always have our break-even price point of 77.29 for the entire trade. So for 100 shares, we generated $230 in initial profit. We have a potential of another 291 on upside potential, and the capital invested was 79.59 for the 100 shares. And to the right in the yellow cells, you see our 20%, 10%, 7% exit guideline price points. Okay, that is section 2, ladies and gentlemen. So we're going to move over now to section 3. Okay, now if you recall, the ticker symbol is carried over automatically. So we're going to use an exit strategy. So we highlight the cell, click the drop down, and we select, let's roll down and sell the stock. Okay, so the adjustment date, let's use the same date, 5/26. And we're going to roll down. So what are we going to roll down to? Let's roll down to the 75 strike. Remember, we started out at the 82.50, and let's say that costs us 30 cents to close. And let's say we generated a premium of $3 because we rolled down, so we're going to get a time value credit. Now, the price of the stock, if it's sold, let's use the strike price and say the stock price the strike was in the money at expiration, we let it expire, and the shares were sold for 75. So we're going to take a loss on the stock side. So that's the roll down, sell stock information put into the blue cells of section 3, which is the adjustment section or exit strategies. And then let's go over to section 4, which is our final results. So our net option result was $5. When you take in the option credits, initial and post adjustment and debits, it came to plus $5 per share, $500 for the 100 shares. And that was an option return of 6.28%. But wait a minute, we lost some money on the stock, $4.59, 459 on the 100 shares. That's a loss of 5.77%. Now, the spreadsheet will then combine the option and stock portions, telling us that on this losing trade, when the price of the stock went down, forcing us to roll the strike down in the same contract month, we ended up with a net profit of $41. And based on our cost basis, that was a return of 0.52% for the 33 days in the trade. Now, if we scroll down here, you see now the number of contracts went from 9 to 10, and it shows us that our net cash positive profit was $27.97. Okay, and that was a combination of the net option profit, the realized stock profit, the unrealized stock loss, and that resulted in a 33-day return of 5.32%. So that gives you your total post-adjusted return. Now, before we get to the put section, I just want to mention one thing. We have devised the spreadsheet such that when you print it out, it will print out in 4 sections. So the first section will be sections 1 and 2 left to right. So starting with stock symbol through 7% guideline. That will be page 1 of the printout. Page 2 of the printout, and it'll also show you the capital adjustment section, which we'll get to, and the initial portfolio returns. So that will all be on page 1. Now, page 2 of the printout will be sections 3 and 4, where we enter our adjustments and get our final results. And that will also show you your total portfolio post-adjustment returns. So that will be page 2 of the printout. Page 3 and 4 of the printouts will be exactly the same, but for cash secured puts. So what we could do is make our printouts, put them into a binder, and you will have an organization of every single trade that we made for every single contract for every single year. So from a management and organizational perspective, all you have to do is print it out and put it into a binder. But really, it's more than that, folks. What we have here is we have a whole history of every trade that we made, and we can actually review them, go over them, and learn from them. And that's how we all become better investors. So from a management, organizational, and learning perspective, we designed this so it can be printed out in a user-friendly manner. Okay, so we did the top half. Now we're going to scroll down to cash secured puts. Now, since I already showed you the covered call writing section, this section is pretty much the same, going left to right. In the blue cells, we enter our trades. Now, in the BCI methodology, we use almost always out of the money puts, which is lower than the current market value. So you see in all these hypotheticals, I'm going to use a real life example coming up pretty soon. The strike price is almost always lower than the current market value. And you have your option premium and the number of shares. So that's section 1. Section 2, the spreadsheet will calculate the number of days in the trade if you take it through expiration, your time value per share and for the total number of shares or per contract, and then the cash required, which is the put strike minus the put premium. And that is the dollar amount per contract. Now it will give you your break-even price point, which is the strike minus the premium. Okay, and then it will give you a return on your option. And based on the number of days in the trade, it will give you your annualized return on the option. It'll give you your dollar amount of premium, total dollar amount. And if the shares are put to us, it will give us the discounted price that we receive when we buy the shares based on when we entered that put trade. So over here, you see that the shares, if were put to us at a price point 4.9% lower than the $50 price when we entered the trade. It will give us our cost per share if exercised, which is really the same as the break-even price point. So column U will be the same as column P. Okay, and then it will give us the cash required in the investment, put strike minus put premium times the number of shares, and that will be the total capital required to secure those puts. And then finally, just like with covered calls, it will give us our exit strategy price points. For puts, it's the 3% guideline, 20%, 10% guideline. So again, if you're not familiar with that, you'll have a little idea if you just put the cursor above the titles. But in the books and online video courses, I give very detailed explanations as to what they are, why BCI created them, and it's just not numbers we picked out of a hat. It's based on years and years of trading experience how we came up with these numbers. And folks, that is section 2 of the cash secured put section. So let's go over to section 3. And section 3, the stock symbol will move over automatically. You select the exit strategy the same way as in covered calls, and you just click on the one that you're interested in. And then you enter the information based on that exit strategy. So once again, you don't have to fill in every cell. It depends on the exit strategy that you're using. And that information is in the user guide in extreme detail. So don't worry about it if you're unsure at this point in time. Now, once you enter the adjustments, then you go over to section 4, which are these white cells here, and it will give you your final net option position, your total profit and loss in a dollar amount, and your percent return based on your investment or the amount of cash that was required to secure each put trade. If shares are put to us, the unrealized loss on the stock and the total stock profit and loss in a dollar amount, and as well as a percentile amount. And as with the covered call writing section, the last two columns are the important ones. It will give us our combined stock and option dollar profit or loss, and then based on our cost basis, our percentile return. And then if we scroll down to the bottom of the spreadsheet, you will see the total portfolio post-adjusted final returns, the net option dollar amount received, unrealized stock loss, the net combined dollar profit, and percent return. And that will be the final one. Section 2 will give you your initial portfolio returns in terms of dollar amount and percentile as well. All right, let's go back to the top now. Let's actually do a trade like we did for covered call writing. Okay, so here I'm going to do a real life trade that I did. I'm only going to use 100 shares, but we're going to do it with XLE. XLE is a exchange traded fund. It's not a stock, and it's an energy select sector SPDR ETF. So basically, it's all the energy stocks in the S&P 500. And the trade was entered on 2/22/22. Now, ETFs, as you know, do not have earnings reports, but some of them do have ex-dividend dates. And the expiration date, we entered the trade 2/22, and the expiration date was 3/18. So it's, I had 2/2 here. It should be 2/22. Let me clear the contents and put 2/22. Okay, so it's about a month, and the price of the security was 68.09. So that's the price of the security when we entered this put trade. And as I told you, we use out of the money puts, so lower than current market value, almost 100% of the time. There are very minor exceptions. And the premium that it generated was $1.40 per share. And we're going to use 100 shares. Keep it nice and simple. Okay, so there's the initial structuring of the trade. When XLE was trading at 68.09, we sold the out of the money 66 put for $1.40, 100 shares, trade date 2/22, expiration date 3/18. Now let's move over to section 2 and see what the spreadsheet has to say. It tells us that we're in the trade for 25 days. A dollar amount per share is $1.40, 140 for the 100 shares of underlying. Remember, for puts, we're not actually buying the stock, but we're entering the price of the security at the time that we sold the put. And the cash required is the strike minus the put premium times the number of shares, 100 in this case, 64.60. Now, the break-even price point is 64.60, put strike minus put premium. And the return on our option, the premium divided by our cost basis, is 2.17%. And based on a 25-day trade, that annualizes out to 31.64%. The total premium in cash was $140. And if the shares are put to us, in other words, if the price of the stock drops below the strike and we take no action to buy back that put, shares are put to us at a discount of 5.13%. And once again, the cost basis is 64.60, which is the same as the break-even price point. And the capital invested $6,460 for for the 100 shares, and then we will have our 3%, 20%, 10% guideline price points. So that's section 2. Now we move on to section 3. And again, the ticker symbol is brought across. So we're going to do a exit strategy here. So we have these choices. Let's roll in because I want to talk to you about that anyway. Okay, so rolling in is a term that probably many of you never heard before, and I was a little surprised myself that this term in the options world was never used before. But if we enter a trade and then find out after the entry of the trade that there is some kind of risky event happening prior to contract expiration, we can, in many cases, move that expiration date closer in prior to this risky event. Let's say we found out that an earnings report date was changed to an earlier date, and we don't want to be in that trade through earnings, or an FDA announcement about a product, or a global event like Brexit. We want to avoid that. So we could take that expiration date and roll it in, close out the later date, and open a new date at the same strike and avoid that risky event. So rolling in is a term actually created by the blue collar investor, and we're going to keep on using it, and it is an inherent part of this spreadsheet here. So we're going to roll in that 3/18/22 expiration date, and we're going to do this, let's say, on 3/7 when we found out about this risky event. And we're going to take that 3/18 and we're going to roll it in a week earlier to 3/11. Now, this is certainly helpful if we have a security that has weeklies. It won't apply to monthlies unless we go out, 2 or 3 months, which I generally don't advise, and we roll it into the earlier month. So this applies mostly to weeklies, but listen, if we can avoid a risky event and maybe keep from losing a lot of money, then it should be a tool in our arsenal. We may not use it every day, but it still should be a tool in our arsenal. So now it's going to cost us money to close that initial 3/18 expiration. Let's say it costs us a quarter. Now the strike price, we're not changing, and we're going to sell the 3/11, and let's say we get 8 cents. Okay. And the price of the stock, let's say it closed at 75.23, leaving that 66 strike out of the money. So the shares will not be put to us. So in this particular trade here, we went across and entered the adjustment. Now, the net option return per share is a little bit lower because we had a net loss of 17 cents. Right? The buy to close and sell to open was a debit of 17 cents. So the $1.40 went to $1.23, and the $140 for the 100 shares went to $123, and their option return went to 1.9%. And that was our final return, $123 and 1.9%. So it's a little bit lower, but we avoided the risky event. So, for a small loss. But now you also have to keep in mind that the cash we use to secure that put is not being used in the last week of that contract. So there's a good chance we could use that cash to secure a weekly put and make even more than the small amount we lost from rolling in. So that shows you the individual trades, and then of course you scroll down and you'll get your final total portfolio post-adjustment returns. Okay, so I'm just going to scroll up because there's one more item I want to show you before we complete this video. I hope you guys are still awake. I know there's a lot of material here, but I think it's going to be well worth it. I think this tool is going to be a real game changer for those of us that use covered call writing and selling cash secured puts. So I want to get back to something I mentioned before, and that's the adjustment section of the spreadsheet. If we're using multiple exit strategies in the same contract month, then we have to enter after the first adjustment, we have to enter the second adjustment in another line on the spreadsheet. So before I do that, let me just scroll down and just show you something here. Okay, so you'll see over here, before we enter another trade, we could see here that at the time I had 25 contracts, right? I had 25 contracts, and the key amount is the total capital invested, 122,860, 122,860. All right, so just keep that in mind. Now let's go back up here. And for simplicity's sake, you could see online on row 105, we use this BCI hypothetical trade. Let's say we're doing a second exit strategy, and I'm just going to use the same trade I used on row 105. So we're using a second exit strategy. So let's just copy that over, BCI and 9/2/21. Expiration 9/24/21. We used the 51 strike. 51 was, but no, not a 51 strike, a 50 strike, because the value of the stock at the time was 51, and the premium was $1.50. And we're going to use the same 400 shares. Now, I just want you to notice here now that if we enter this line, the spreadsheet will think that we're actually investing another $19,400. That's just the nature of the spreadsheet. When we enter a trade, it will give us the amount of cash required to secure that trade. But in reality, we're using the same cash that we used on the previous trade in the same contract month. We're just generating a second income stream or a third income stream or a fourth. If we're doing multiple exit strategies, we have to somehow account for that 19,400 that is not an additional investment that we're making. So what do? Well, we scroll down and we enter, which stock are we talking about? BCI. What do we want to do over here? This is the adjustment section, folks. We want to deduct 19,400. So we put minus 19,400. Clear that. Okay. Now we did that, and the calculator will now bring us back to that 122,860. Okay, if we didn't put that in, it would bring it up to 142,260. We put it in, that number 142,260 goes down to 122,800. So the capital adjustment entry section is specific when we use multiple exit strategies in the same contract cycle. Okay, so let's go back now to the top because we're done. Ladies and gentlemen, the BCI team spent a year and a half, and we loved every minute of it, developing this tool for all of us, because I'm going to use it, my team's going to use it, and it's available to you also. We feel that, to our knowledge, there is no other spreadsheet like this anywhere. I could be wrong, but I don't think so. And we also believe that this is, and I used this term before, going to be a game changer for us, because it will allow us to organize, manage, and learn from every single trade that we executed in every single contract cycle for an entire year. And then we can put it in a binder and save it. It prints out in the 4 sheets that I alluded to before. So that's the purpose of making this video, to show you everything that this tool has to offer. And I hope you are as excited about it as we are. So in April of 2022, this new product was launched, the BCI Trade Management Calculator. And I'd love to hear from you on how you feel of this tool and what it did for you in terms of your investment success. Want to thank Barry Bergman, the BCI Managing Director, who worked with me for that year and a half, along with other members of the BCI team to create this tool. And I want to thank you, everybody out there, who put the blue collar investor on the financial map, gave us the ideas to create this product, as well as thank you for taking the time to listen to and watch this detailed video presentation of the Blue Collar Trade Management Calculator. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.